So welcome everyone. This is episode number 10 of the $1 Million Case Study. Time has flown by. It's crazy to think that we've already done 9 of these and this is the 10th one. Tonight we have on Stuart Patton. I'm going to start off with a few slides just to show you guys where we're at in this case study. Then I'm going to tune it over to him and he's going to talk to us about everything we need to know around a legal structure and as far as taxes go. So, like I said, session number 10, tonight we're gonna be talking about tax and legal advice. But like I said, real quick, I want to give you an update of where we're at with our product that we chose, the hooded baby towels. Okay, so we found this opportunity, we found a factory, we've put down a deposit. Last week we had the factory mail us a kind of, I want to say like a true sample or a production sample. So the first set of samples we got from them, the fabric wasn't actually the thickness of what we wanted for our production run. So they made us a sample that's more, that's the actual thing. It'll be the actual thing that they're producing on this production run. So they mailed this to Gen. He snapped some few pictures for us. This is the actual, the hooded baby towel. This isn't our actual packaging. I'll show that to you next. This is the actual washcloth that's going to be included. And then these are a sample of the pink and blue color. We're going to do 3 different colors, so the pink, blue, and the white. So, and yeah, we were really impressed with the production sample. It's very high quality. We think we can get 5 out of 5 star reviews on Amazon, which is a good thing. This was our packaging design. So this is what we sent into them. And they sent us back pictures of the first run for us to check. So they sent us these pictures, I think last week on Friday. So this is what it looks like actually printed on the box. I think it looks pretty nice. This is actually a hole. I guess they just put something black behind it so we could see it's in a hole, but that's like a little like peep window to be able to see what the fabric color is or what the fabric looks like. So yeah, I'm pretty impressed. I think our packaging turned out pretty nice. They're actually mailing this packaging also to Gen. I think he's supposed to get it on like Friday this week and we can physically touch and make sure that this is what we're looking for. And I also wanted to announce today that we have officially partnered up with Pencils of Promise. So the last case study we did, we donated all the profits to Doctors Without Borders. They were great to work with. This time we chose to just do something, work with someone else, just kind of like spread the wealth out. So all of the profits from this particular case study are going to go to Pencils of Promise. And it's super cool because about every $50,000 that we raise builds a school in a developing country around the world. So throughout the $1 Million Case Study, we think we can probably profit $250,000, which means we're going to be, the profits from this case study are going to be building 4 or 5 schools. And to me, that's like super cool to think about, that to know exactly like what your money's going towards. Every $50,000 actually builds a real physical school that they can take pictures of and send us. So that's super exciting. We're really excited to partner up with them and be working with them. So I just want to announce that and kind of tell you guys where all the money from this is going to be going. So with that being said, I want to introduce to you guys Stuart. We emailed him a few weeks ago, invited him to be on this. He has a very unique perspective with tax and legal stuff. I'm going to let him introduce himself a little bit better, but it's cool because he works with, he specializes in U.S. citizens living outside the U.S. and doing their taxes. But he has a unique perspective because he knows a lot about doing taxes if you're an American living outside the U.S., as well as he knows some if you're someone not an American citizen, if you're a citizen of a different country and you want to be selling stuff in the US. So I thought he'd be a great candidate to have on this webinar. So with that being said, Stuart, take it away.
Great, thanks a lot, Greg. And thanks everyone for joining. Normally I present on these topics to one of the 3 groups individually that Greg mentioned, resident Americans, non-resident Americans, and people living outside the U.S. So strap yourself in. This is going to be a 3-hour webinar because I'm talking to all 3 groups at the same time. But actually, we'll try to stay within the normal hour time frame. But things, may cover things with a little less detail than I'm used to. So, please fire away your questions in the chat, and we'll get to as many of those as we can. So who are you? So let's define these three groups that I mentioned in a little more detail. So first is, resident American. So this is, people who wake up every morning in the U.S. Also, it includes people that I call half-pats. You're not quite an expat, but you spend maybe 6 months in the U.S. and you spend 6 months outside the U.S. typically in a year. Well, that's not enough time outside the U.S. to fall into the next group, which is non-resident Americans, U.S. expats. So these people are U.S. persons for tax purposes, meaning that they are citizens or they are lawful permanent residents that have a green card, but you live outside the U.S. more or less full time. Okay, so this is you if you you left the U.S. and you went to Chiang Mai, or you're traveling around, or you just live full time in some place outside the U.S. and you only go back to the U.S. to visit grandma for less than a month a year, something like that. Okay, and then the third group is basically people who are not in either one of the first two groups. So it's everyone who doesn't live in the U.S. and is also not a U.S. citizen or a green card holder. Okay, so it's very important that you understand which group you're in, and the legal structuring and tax aspects that we're going to discuss vary greatly depending on which group you're in. And strategies that are awesome for one group can be absolutely disastrous for another group. So so if you might learn about a strategy here that works for one of the groups, but you're not in that group, well, the way to use that strategy is to join that group. So, for example, if you live in the U.S. And you like what you see as far as tax consequences for Americans who live outside the U.S., well, you jump on that plane to freedom, and you can save a lot in tax. So, so first of all, let's talk about a couple of preliminary things, and then we'll dive right into the substance of talking about the legal structure to use for your Amazon business. So first of all, whenever you're talking about tax, it's very easy to forget that tax is actually a body of law. Okay, so there's one simple question that you should ask someone before you listen to what they say about tax, and that is, where did you go to law school? Okay, so it's very easy to get on the internet and find people talking about the U.S. tax aspects of selling on Amazon, whether you're an expat American or whether you're a non-American. There's just tons and tons of voices, but the only qualifications to post something on the internet are an internet connection. So if you remember to keep in mind that tax is a body of law, then that will go a long way to steering you away from a bunch of the yahoos who just type stuff on a keyboard. So with that in mind, I'll tell you where I went to law school. So I grew up in Oklahoma, and that's why I kind of sound kind of like Greg, I guess. We're kind of from close to the same neck of the woods in the U.S., sort of. And then I went to undergrad at Texas A&M University, law school at the University of Houston. And then I worked in Houston for a while, and then moved to Chicago, and I was a partner at a law firm called Kirkland & Ellis in Chicago. But after about 6 Chicago winters, I had enough of that and got really tired of the whole big law firm lifestyle, never seeing the kids, and everything that kind of goes along with that. A lot of you might know exactly what I'm talking about, which is why you want to start your Amazon business. And so luckily my wife is from Belize, and so we moved to Belize, and I started my own practice. And so in addition to helping Americans who live or invest abroad, I also help non-Americans who are looking to sell into the U.S. So basically cross-border international U.S. tax and legal structuring is what I do. Okay. Now, this is kind of where everyone starts, is the no structure legal structure. It's just you operating your business. So the thing I want you to keep in mind is that, it's kind of like an old, and I might be dating myself here, but there's like an old Rush song, I think, where there's a line that, if you choose not to make a choice, if you choose not to decide, you still have made a choice, So if you just fire up your Amazon seller account in your own name, and you are buying stuff from your supplier and you're selling it on Amazon, well, you have chosen consciously or not, to use the no structure legal structure. You know, that you're just swinging free and easy, you know, operating a business in your own name. Now, this is really not the best thing to do, because if something were to happen where there could, you know, where some legal liability sort of issue, like someone chokes on one of your products or something like that, well, you're the one who sold them that product. You know, you, the human, sold them that product, and so they get to sue you, and they get to take your stuff, not only that's related to this business, but they get to take your stuff that's not related to the business. So, so that's, you know, the biggest advantage of having a legal structure around your business is that it limits your liability. So instead of them being able to sue you, person they bought the product from, which is the legal entity through which you operate your business. So, so that's the biggest reason to have a structure, to not use the no structure is to limit your liability. You know, it doesn't need to be an expensive thing to have a legal structure. You can fire up an LLC pretty cheaply and go from there. So let's okay, so let's move on to that. So here's the legal entity that we're going to talk a lot about, and actually you'll see that this legal entity is actually useful in all three of the different scenarios, you know, for all three of our different groups, and that is the limited liability company. Okay, so what we're talking about here is an entity that's formed under the laws of a U.S. state, and that is a limited liability company. So each state in the U.S. Authorizes, you know, the formation of all sorts of different legal entities. Typically there's 7 or 8. And the two that most people know about are the corporation and the limited liability company. So the limited liability company is the one that we're going to be focused on. That's the one that you're going to want to use, okay? And you'll see why. Okay, so some terminology here. You organize an LLC, like that's kind of the technical term. You don't incorporate an LLC. You incorporate a corporation, but you organize an LLC. So here are the people, the humans that are related to an LLC. The members own the LLC and managers run the LLC. Okay, you're probably more used to corporation sort of terminology, where you have a shareholder who owns the corporation, and then, you know, a director or a board of directors runs the corporation, or, you know, they hire an officer who then hires other people, you know, to run the corporation. But it's the same thing with an LLC. It's just that it's a different legal entity, so, you know, it's got to have different names for everything. So the members own it, managers run it, and then just to make things a little more complicated, an LLC can actually be member managed, and that means that it doesn't have any managers. Okay, so the member are the ones who actually run the company. Okay, so okay, well, that brings us to the first group. Okay, resident Americans. So let's talk about the legal structure for you, and then we'll talk about the tax aspects of the legal structure for resident Americans, and then we'll just march through the groups, talking about next about expat Americans, and then next about non-Americans. Okay, so so the easiest and the best legal structure for you to use if you wake up every morning in the U.S. is a limited liability company. If you're the only person that runs the business, well, then you can be the sole member of that limited liability company. Okay, and then for U.S. tax purposes, the LLC is what's called a disregarded entity. And what that means is the LLC is disregarded as a separate entity from you for U.S. tax purposes. Okay, so that's the default treatment. So if you simply form an LLC and you are the only member, so you're the only person that owns the LLC, then that's called a single member LLC, and that LLC is disregarded as a separate entity from you for U.S. tax purposes. Okay, and so what that means is all of the income and deductions and everything related to the business of the LLC appear simply on your tax return. So it's exactly the same, for tax purposes, it's exactly the same as having no legal structure at all, okay? Because the LLC is simply disregarded. Now, if you have partners, then each of your partners will be a member of the LLC, and then the LLC by default will be a partnership for U.S. tax purposes. Now, substantively, the tax aspects are exactly the same, essentially. It's a little bit complicated. A partnership is what's called a flow-through entity, and that means that the partnership itself, the limited liability company itself, when it's treated as a partnership for tax purposes, it does not pay tax. Instead, it simply allocates income up to the partners. Okay, so it's basically just a complicated way to kind of like send income and deductions up to the humans, and the humans put it on their own individual tax returns. Now, the partnership itself also has to file a tax return. So whenever you have a multi-member LLC, there's going to be some more tax compliance to do because that LLC itself has to file a partnership tax return, and then that income flows up to each of the individuals on their individual tax return. Okay. Then in both of these cases, either where you fire up a single member LLC because you're the only one running your business, or where you have partners and you use a multi-member LLC, in either case, the LLC can elect to be treated as what's called an S corporation for tax purposes. Okay, so now this is where sometimes I see a lot of weird stuff online. People get kind of confused. So the entity that you create under the law of this, whatever state you live in, is still a limited liability company. Okay, that's the entity that you're creating. But then for tax purposes, you're making an election. You're filing a piece of paper with the IRS that elects for the entity to be classified as an S corporation for tax purposes. And it's called an S corporation because the tax rules are under subchapter S of the Internal Revenue Code. Okay, like the normal sort of corporation, like when you're talking about like publicly traded companies and things like that, those are called C corporations. Okay, you don't want to use a C corporation. That's a bad thing. Okay, you want to use an S corporation, and you'll see why here in just a second once we get into the tax aspects. But basically, a C corporation is a separate little person for tax purposes, so it pays tax. So if you use a C corporation, there would be two layers. One layer of tax is bad enough. Okay, so you don't want to have two layers of tax. But an S corporation is a special sort of flow-through entity, much like a partnership. Okay, so I hope everyone's still awake. So now we're going to talk about
everyone's still awake. Stuart, I would have a quick question. Is there a certain revenue level that an S corp makes more sense?
Yeah, this is a well, here, let me kind of talk about, so the next couple of slides, I'm going to talk about the tax aspects of being self-employed versus being an S corp, just to make sure that we're all on the same page and everyone understands this. So that's a question, one of the more advanced people who kind of is already ahead of me has asked. But yeah, let me sort of come back to that. I think it'll make a little more sense once we talk about, or I can talk about it a little better once I kind of talk about the preliminary stuff. Okay.
Perfect. Thank you.
Yeah. So let's say that you form a single member LLC because you're the only one who's running your business, or you form a multi-member LLC and you don't elect S corp status, so it's a partnership for tax purposes. In either case, you are a self-employed human for tax purposes. That's the term for you. Like when you have a job, you have a job and you're an employee. Well, when you operate your own business through the structure, you are self-employed. So, you're used to paying the good old U.S. federal income tax, but now you also get to pay the self-employment tax. Okay, and it is a different tax, and it applies simultaneously, the two taxes. So you get to pay both of them. And so how self-employment tax works is it's 15.3% of your income up to $118,000. Then above that, all the way until forever, it's 2.9%. Okay, so at least you kind of get a little bit of a break once you get above $118,000. Federal income tax, is at graduated rates. Different rates apply to different levels of income. Depends on whether you're filing, singly or jointly or head of household or whatever. And those rates, go from 10% up to 40%. Well, it's 39.6%. And so basically, as a self-employed, you get to pay both of these. Now, federal income tax, that's money that you give to the federal government, and they do whatever they do with it. Self-employment tax is a little bit different because you're kind of paying that into the Social Security Administration, And so theoretically, if all goes as planned, 1,000 years from now, when you retire and you get Social Security, then you'll get this money back, kind of, right? With some assumptions, you may need to live to 100, 165 to kind of get it all back, and you may have a negative return on your investment. But that's kind of the theory anyway. Okay, so this slide is kind of unduly complicated probably, but so bear with me for a second. So this, in the previous slide, we were only looking at this middle column, okay, net profit from your business, like all of the money you make in net, not gross. So not like your sales revenue, but the money left over after you pay for everything, okay? And so when you're self-employed, then the self-employment tax and federal income tax applies to all of your net profit. Whenever you operate through an S corporation, things are a little bit different, and this is why people use an S corporation. So the S corporation pays you a salary, okay? And so a portion of the net profits is paid to you as from the S corporation as a salary for your role in running the business, doing work, okay? And then the part of the net profit above your salary just is simply allocated to you, because an S corporation is a flow-through entity, much like a partnership. So it allocates its net profit above the salary up to the owners of the S corporation. Okay, so it's only the salary portion. It's only the salary portion that is subject to employment taxes. Now, I should have changed this part of the slide. Technically, you pay employment taxes. It's only a technical thing because the amount is exactly the same, but technically, like the S corp, half of the tax, and you pay half the tax. But if you own all of the S corp, well, then it doesn't really matter. So it's only this portion, the salary portion, that's subject to self-employment tax or employment taxes, and then your net profit above your salary is subject to only U.S. federal income tax. So this is the whole reason for using an S corporation, is that you get to save some on the self-employment tax. Okay. Okay. So let's go back to Greg's question about, is there a certain income number? Yeah, it's a little bit complicated. If this is something that if you're a resident American and you are starting a business and you start making some money, go to a local CPA in your state. Okay, go to an accountant in your state and talk to them, and they will be able to kind of explain the whole thing to you, from soup to nuts. And the reason I think it's important for you to talk to an accountant in your state is that there can be different state tax aspects to the question of whether to use an S corporation or just to keep operating through an LLC. Certain states make it better or worse to use an S corporation. So it's one of those things where once you reach the point where you're making enough to even have the question of, will an S corporation help me, sit down with the local CPA and they can run the numbers and just show you exactly how much they'll help. Now there's a little bit of a balancing act here, because whenever you have an S corporation, obviously that S corporation needs to file its own tax return. It files an S corporation tax return. And then there's a bunch of payroll stuff you have to file too, like additional forms for the employment taxes. So there's a bunch more compliance. And this is not a do-it-yourself project. So that's why you need to go see a local CPA, because you're going to have a tax nerd on your side to file all this stuff for you. You absolutely don't. It's not worth your time to try to do it yourself, So yeah, just whenever for resident Americans, it's pretty easy. You fire up an LLC, let it be a single member LLC or a multi-member LLC. Let it be a disregarded entity or a partnership, and then it may make some sense at some point once you start, once you get some traction, making some money, it may make sense to flip that over to S corp status, and that's something that you should sit down with a local CPA and go over once you get there. Okay, now this is where I've presented for hours on just on this topic. So it's a little bit complicated for me to like just distill it down to. I kind of feel like I'm not covering everything all that well because I have to distill it down. But hopefully I can kind of just like hit the high points and kind of give you you know, food for thought basically. And you know, obviously I've got a bunch of articles on my website that you can check out that kind of go into a lot more detail about how all this stuff works for non-resident Americans. But here's the structure, just so you can see it. Okay, so before we had you, the human, operating your business through a limited liability company. So now with non-resident Americans, we are going to interpose a non-U.S. corporation between you and the LLC. Okay, and so then this line shows that, well, you know, you're still running the business because you're the manager of the LLC. So the LLC now is a manager-managed LLC. It's not a member-managed LLC. It's got a member, which is the non-U.S. corporation, and it's got a manager, which is you, the human there. So everything's blue. So this structure, you kind of have to be a little bit schizophrenic to understand it, okay? Because it looks completely differently whether you're thinking about it from an operational perspective or from a tax perspective. So from an operational perspective, the LLC is the main entity. This is the entity that runs your business, okay? So when you have an Amazon seller account, then it's in the name of the LLC. The bank account where the money for your business runs through is a bank account in the name of your LLC. You know, if you have a domain name, if you have other parts of your business, you know, employment contracts if you have employees or independent contractors who work for you, then that's all in the name of the LLC. So this is where the business operates. So this is like the main entity from an operational perspective. However, from a U.S. tax perspective, this is a single member LLC, right? Remember, so it's disregarded as a separate entity from the non-U.S. corporation. So it just doesn't exist for U.S. tax purposes. So this is where the action is. This is the main entity for U.S. tax purposes. It's at the non-U.S. corporation level. So the whole idea of this structure. Now, if you just know a little bit about expat tax, you may kind of wonder, well, why do I need to have a non-U.S. corporation? I mean, isn't there this thing that's the foreign earned income exclusion that allows me to make up to about $100,000 a year without paying any U.S. tax? The foreign, and this is kind of where I begin to give short shrift to these topics. Okay, if you're an American and you live outside the U.S., I'm going to kind of assume that you've heard of the foreign earned income exclusion. Basically, how it works is if you pass certain tests, meaning generally that you stay outside the U.S. for 11 months per year, then you qualify for the foreign earned income exclusion. Okay, most people think the foreign earned income exclusion is simply $100,000 tax-free, but that's not quite how it works exactly. It's actually quite a bit different than that. Okay, so first of all, there are kind of three different problems with simply using an LLC and not using a non-U.S. corporation. First, if you simply use an LLC, you'll still pay self-employment tax because you're self-employed. Okay, and so the foreign earned income exclusion doesn't do anything for self-employment tax purposes. It's only a benefit for U.S. federal income tax purposes. So if you make, you know, on that first $100,000 that you don't pay any U.S. federal income tax on, you still pay $15,000 of self-employment tax. Okay, the next thing is the 30% rule. So the foreign earned income exclusion does not simply get you out of tax for the first $100,000. Instead, what it does is allows you to make up to about $100,000 from providing personal services, and you don't have to pay U.S. tax on that amount. So the income has to be from providing personal services. Okay, so if you have a job, then your first $100,000 of salary from that job is foreign earned income, and you don't have to pay any U.S. income tax on that. But if you own a business, so if you were to just fire up an LLC and be a self-employed human owning, you know, an Amazon FBA business, then this nasty thing called the 30% rule comes into play. So when you have an Amazon FBA business, you have to put time and effort into the business to make it work, right? You have to select the products and, you know, find a supplier and you know, inspect the packaging and all that stuff that Greg talked about at the beginning, plus a lot more stuff that you know, Greg also talks about in the case study. But But you also just have to put some money into it, right? I mean, you have to buy something before you can sell it. So the amount you make from your business is a return not only on your time, but it's also a return on your money. So the IRS says, okay, we're going to allow you to treat only 30% of the net income from your business as foreign earned income. So we're going to allow you to, basically what they're saying is, we're going to allow you to treat only 30% of the income as being for your personal services. So that means that with respect to 70% of your income from your business, you're paying U.S. federal income tax. If you just operate through an LLC, the foreign earned income exclusion doesn't help you. Okay, and the third thing, let's not talk about this in detail, but there's something called the scale back rule. That's really complicated, but basically, whenever you have gross income over $100,000, and you have deductions that reduce that, then you can't use the foreign earned income exclusion and a deduction against the same dollar of income. So basically, the effectiveness of the foreign earned income exclusion is reduced. Okay. So here's the cool thing about operating through a non-U.S. corporation. You're not a self-employed human. Instead, you wear two hats for U.S. tax purposes. You are the person that's running the show. You know, you're doing work for the company that owns the business. But then also you're, you know, Mr. Monopoly man over here who just, you know, you're a fat cat sitting back and owning the business and whipping this person into shape, you know, to run the business and make you some money, you know, just by virtue of the fact that you've invested in this non-U.S. corporation. Well, if you were to get a return as dividends, you know, just for being the fat cat sitting back and making money, then that's taxable income. I mean, there's no special rule that exempts dividends from tax when you live outside the U.S. But for this amount that you make for working, for your salary from the non-U.S. corporation, that qualifies for our friend, the foreign earned income exclusion. And the cool thing is that you're not self-employed. So those nasty, the nasty self-employment tax, 30% rule don't apply. You simply get a clean $100,000 about. The number, I always say about $100,000 because the number is indexed to inflation. So for 2016, it's $101,300, and it'll go up by like a couple $1,000s a year. So $1,000 for like the next 3 years at least, and then I'll switch to 110 or something. So so that's the reason. That's the reason for putting a non-U.S. corporation in between you and the LLC is that you take all that complicated business income that you know has these negative rules attached to it, and you just simply turn $100,000 of it at least into a nice clean stream of compensation to you as an employee of a non-U.S. corporation. And then if you leave the rest of the money in the company, like don't pay it out as dividends, then you don't pay any U.S. tax on that amount either. So you can invest it underneath the company, and you won't pay any U.S. tax until it comes out to you as a dividend. Okay, so let's say you have a year where the company pays you a salary of less than $100,000, and then the rest of the net profit of the company, you leave it in the company. Well, your U.S. tax bill is $0 that year, and that's a perfectly legal thing to do. Now, with respect to the net profits above your salary, you're kicking the can down the road. You know, you're deferring the U.S. tax on that amount. You're not eliminating it. So one of these days, you know, when you're old and gray and you're no longer running your business and you're sitting on a beach somewhere, you're going to be pulling dividends out of the company, and you get to pay U.S. tax at that point. But you've obviously deferred the U.S. tax. So in the U.S., and you make $100 of net profit, you may only get to invest, you know, 35, you may only get to invest like 65 of those dollars, or if you live in California, 60 of those dollars, or 55 of those dollars. If you live outside the U.S. and you keep that money below a non-U.S. corporation, you get to invest 100 of those out of that, you know, $100, and then down the road you're going to pay that tax. But the ability to invest it in the meantime is pretty awesome. I've actually run spreadsheets for someone who like say for example that you're like, okay, I want to start an Amazon business, and you live in the U.S. Imagine that you start a business and then sell it, okay, over the next like 3 to 5 years. Well, if you do that in the U.S., then you get to pay tax on all of your operating income before you sell it, and then you get to pay tax on your income, on your gain on the sale. Well, if you move outside the U.S. for that 3 to 5 years, then you defer. Well, first of all, you eliminate tax on the compensation portion, and then you defer tax on the net profit above the compensation. And when you sell the business, you would do that by having the non-U.S. corporation sell the interest in the LLC. And so you can defer paying U.S. tax on your gain on sale as well. And then you can even move back to the U.S. Once you're no longer operating a business, you can move back to the U.S. and hold that bucket of cash and investments that you make with that cash, and still defer the tax until it comes up to you. Now, this is why I said earlier that you can't cross the streams here. Like you're in one of these 3 groups, and this structure only works for people in the second group. Okay, so if you're in the first group, if you live in the U.S., a non-U.S. corporation is a way to pay more U.S. tax. It just does not work. Okay, there's no way in the world to use a non-U.S. corporation if you wake up every morning in the U.S. It's just not going to save you tax, and it's actually going to cause you to pay more in tax. And I say this as a person who, I sell the service of setting up non-U.S. corporations and making sure they're structured correctly and, that they're reported correctly for tax purposes. So if it worked for you, I would love to, have you as a client, but unfortunately, it just doesn't work. So again, this is only for non-resident Americans. Okay. Okay, so the third and final group is people who have hopefully not fallen asleep already and have stayed awake to hear their part of the presentation. So this is for you if you live outside the U.S. and you're not American. Now, there's a lot of potential variety here. You can do different things depending on your local tax circumstances, okay? So what I'm focused on here is a lot of non-Americans who sell on Amazon US would like to have a US bank account to avoid multiple currency conversions. Like if you can sell on Amazon either using a no structure like just yourself, or like through a non-US corporation, maybe that's in your country of where you're a tax resident. You can do that, and you can have a non-US bank account. But the problem is that if you have a non-US bank account, then Amazon can pay you in the currency of that country, even if your account is a US dollar account. And so you can have like multiple currency conversions as you take that money from Amazon and pay your suppliers and pay people who work for you and things like that. So so having a US bank account can avoid a lot of those issues. So that's the reason why our friend, the LLC, is very helpful for non-US folks as well, because it allows you to have a US bank account that you can use in connection with your business. Another reason, if you're selling off Amazon as well, like on your own site, then a lot of times if you have a non-US bank, then there are issues with charging credit cards. A lot of them get rejected and stuff simply because there's a non-US bank account associated with it. And that can be very annoying. And so having a US bank account can be very helpful. So that's why the limited liability company is useful for you. Is basically it's a US legal entity that allows you to have, first of all, it allows you to have, if you don't have a non-US company already, then it gives you liability protection, so that's a really good thing, So, and then it also gives you access to US business banking. You can open a US bank account in the name of your LLC. Okay. So the previous slide with showing just a non-resident alien with only an LLC, that's because that was a single person who owns a business themselves. If you have a business partner, then you don't want to have you and your partner both be members of the LLC. If you do that, then remember from several slides ago that the LLC would be a partnership for U.S. tax purposes, and the LLC would therefore have to file a partnership tax return. And as we're going to talk about next, U.S. tax. Okay, and this may come as a surprise because there's a lot of nonsense on the internet about this topic. But so it'd be kind of annoying if you had to file a partnership tax return for this LLC, even though you didn't have to pay U.S. tax. It would be you'd have to get a CPA in the U.S. to do that. So it'd be a compliance burden just for no reason, because the LLC would be allocating the income. It wouldn't be paying tax. It'd be allocating income up to you, but you don't have to pay tax either. So instead, what you do is have a non-U.S. corporation. So you do the split outside the U.S. And so that allows the LLC to once again be a single member LLC because it only has this non-U.S. corporation as its member, and so therefore it does not have to file a partnership tax return. Okay. So yeah, I remember all this stuff about like paying tax. Well, when you are a non-resident alien, you don't have to worry about that as long as you are not engaged in a trade or business in the United States. Okay, so I put that in quotes because it's like a defined term for this purpose. Okay, so I call it ETBUS for short sometimes, ETBUS, engaged in a trade or business in the United States. So what does that mean? Well, you are engaged in a trade or business in the United States only if two things are true. One, you have at least one employee or other person that's called a dependent agent in the US. And the second thing that has to be true for you to be EBIS is that that person does some activity that's sort of substantial related to furthering your business in the US. Okay, so let's talk about each one of these in more detail. So an employee obviously is someone who walks in every day at 8 o'clock and they have their lunch pail, you tell them what to do until 5 o'clock, right? So that's kind of pretty easy. But what I mean by another dependent agent is like someone who you may think of them as an independent contractor, but really they work for you full time. So really for all intents and purposes, they are really, even though you may kind of pay them on more of an independent contractor basis, or maybe you found them through a way that's more independent contractor. So it's basically, it's your person, it's someone who works for you. Well, let's think about different people that may help you with your business. Well, what about Amazon itself, like the company? Is Amazon itself a dependent agent of yours? Well, no. They do help you. They are an agent of yours, but they are an independent agent. Okay. And the reason for that is that Amazon, they have kind of their own little business going on, right? And they love you and everything, but you are only one small aspect of their business. And their business is, they're in the business of helping people like you. So you are one of their clients or one of their customers, right? So they are an independent agent of yours. They're not a dependent agent. You can't boss Amazon around, right? And then what about the humans who work for Amazon, who are like, picking your product and sending it out to customers? Well, those humans obviously work for Amazon, so they're Amazon employees. They're not your employees. So if all you do is sell on Amazon FBA, then you don't have any employees or dependent agents in the U.S., and therefore you cannot be engaged in a trading business in the U.S., and therefore you don't have to pay any U.S. Income tax. Okay, well, let's say there's someone that is in the U.S. That you just absolutely have to have working for you because they do something awesome. Well, you would be EBIS only if that person is doing something substantial in the U.S. So if they're only doing something that's like administrative or ministerial, like maybe accounting, keeping your books or something like that, that's probably fine. They're not like, just because like the books are kept in the U.S., it's really hard to say that your business is now being operated from within the United States. That keeping the books is kind of like a boring sort of, perfunctory, functionary sort of task. And so that doesn't mean that that's not the meat of what it takes to make money. So yeah, so there's some ability to hire a person like that in the U.S. Best thing is don't hire people that are in the U.S. Now, also one thing to mention: this exact issue. Okay, so remember what we're talking about here is we don't want non-U.S. persons to be subject to U.S. tax. So this exact issue arises for people in the second category that we just talked about for expats, U.S. expats. It arises with respect to the non-U.S. corporation. Okay, so we don't want that non-U.S. corporation to be engaged in a trade or business in the U.S. Okay, so this exact issue arises for expats as well. So yeah, okay, so this is a mess of a slide kind of, but I won't cover this in great detail, but I kind of wanted to explain why you may read on the internet that that non-resident aliens who sell on Amazon do have to pay U.S. tax. Well, the reason you may read that is where these rules are located is in a complicated place, and so it's not something that is simply black letter law. So the Internal Revenue Code, that's like the statutes that Congress passes, determines how tax works. And then the Internal Revenue Service, the IRS, interprets those statutes and comes out with Treasury regulations that define and refine the rules a little bit. And then if taxpayers or potential taxpayers and the IRS disagree about how the rules apply, well, then they may go to court, and then that leads to this whole big body of case law. So it turns out that unfortunately the Internal Revenue Code and the Treasury regulations are just not very clear on what it means to be EPIS. And so there's a whole big body of case law about what it means to be EPIS. And also those cases were all decided between like the 1920s and the 1960s. Okay, so guess how much e-commerce was going on at that time, right? I mean, there's no online selling because there was no online anything. There's no line, to be on. So, so yeah, you kind of have to read those cases, apply them to these new facts. So that's why you end up with a lot of confused people. And also, I'm kind of being generous here. I mean, some people say that you have to file a U.S. tax return simply because they are in the business of filing U.S. tax returns, and so they're not too inclined or motivated to think very hard about the issue. If they have someone who thinks they need to file a U.S. tax return, well then, sure, let's do it. And it costs you this much, and let's go. So, but that's the thing to remember, is that when it comes to U.S. income tax, as long as you don't have any of your own people in the U.S., well then you're not paying U.S. tax. Well, so then the question might be, where are you paying tax? Well, most countries outside the U.S. have what's called a residence-based tax system, and so how that works is if you're a resident of that country, then you pay tax in that country. So if you woke up this morning in Australia, and that's where you wake up most mornings, you're probably an Australian tax resident, and so your income from selling on Amazon in the U.S. or in the U.K. or in the EU, should be on your Australian tax return. Because that's where you pay tax, and that's sort of an international norm here. Like this whole EPIS rule. Well, it works the same way in Canada. If you're engaged in a trader business in Canada, you got to pay Canadian tax. Same thing if you're engaged in a trader business in the UK, you're supposed to pay UK tax. So if you're in Australia or the UK or in France, well, that's where you pay tax, not in the US. Now, if you used to be Australian, if you used to live in Australia, but you've lost, you've done the steps necessary to lose your Australian tax residence, and you're bouncing around to, Thailand and, part of the year, and Tokyo part of the year, and Medellin another part of the year. Well, that's awesome. You may not be a tax resident of any jurisdiction, and in that case, you don't have to pay tax anywhere. So ignore this Wyoming. Wyoming is the state I use for LLCs for expats and for non-resident aliens. People in groups 2 and 3. For people in group 1, you just use an LLC in your state. So what I wanted to cover, I want to make sure that I've been talking about like a bunch of ideas and tax and things like that. I want to make sure that at least for resident Americans, okay, things are a little more complicated, unfortunately, for expats, U.S. expats, and for non-resident aliens. But at least for resident Americans, I want you to leave here with at least knowing the concrete steps to take to fire up a legal structure. And it's really easy to do, okay? So like if you're a resident American, really just fire up an LLC, now you know the word organize an LLC before you open your Amazon seller account. Because eventually, if you switch to an LLC later, you're gonna have to open up another, you have to switch your seller account, which there can be some delay there, and while you do that, so you might as well just do it one time. Just fire up an LLC before. That's just kind of part of being an entrepreneur, part of doing a business is through which you do business. So here's what you do. You simply form the LLC by contacting what's called a registered agent in your state. Okay, each LLC must have a registered agent, and what that is an LLC is a separate legal person, and so that means it can sue and be sued. And so if someone wants to sue your LLC, well, they serve papers on the registered agent. Okay, so so just form an LLC in your state where you live by contacting a registered agent in your state, and just Google Georgia registered agent or Connecticut registered agent, and off you go. I mean, pick one. It shouldn't cost a ton of money. Like don't use like one of the expensive incorporation services. I think there's like incorporate.com. There's a bunch of others. LegalZoom. If you listen to podcasts, you hear that one advertised. They're just more expensive. So go straight to the. They're just like anything else. I mean, they're kind of the middleman. So there's a markup. So just go straight to a registered agent and form an LLC, and it won't delay. It's going to be very cheap insurance if someone slips on or chokes on one of your products. Okay, next you go to irs.gov and you get an employer identification number, and you capitalize the I for your LLC. Okay, so you as a U.S. citizen human, you have a social security number. Well, an employer identification number is a social security number for a legal entity. And there's a cool little online widget. So just go to irs.gov. There's a search bar in the upper right. Search for employer identification number, and you'll go to the little online thing. You'll answer some questions. You'll have your EIN about. Oops, what happened? Okay. You'll have your EIN about a couple of minutes later. Okay, and then the final thing you do is you open a bank account in the name of the LLC, and all you do is you go to go to your favorite billion-dollar bank's website. Or if you're a credit union person, go to the credit union and say, "Hello, I'd like to open a bank account for my LLC." And they say, "Great," and then they'll talk to you about credit cards too, and maybe home loans and stuff like that while you're there. But it's super easy to do. It's all of these things are things that are done like literally a million times a day. Okay, so like registered agents are in the business of forming LLCs. They'll guide you through the process. The online thing to get an EIN is really easy. And then banks are in the business of hanging on to your money, and so they'll guide you through the process. So this isn't something that don't feel like, oh, I don't know how to form a legal entity and it's hard. Just go do it before you start selling stuff. Now, unfortunately, each of these steps is kind of different. Like for people in the second group or the third group, like for example, the online widget to get an EIN works for people who live in the U.S., but not people who live outside the U.S. Also, if you're a non-resident alien, then you need to get a number as well. It's called an individual taxpayer identification number. Also, forming a non-U.S. corporation can be a little more complicated than forming an LLC for expats. Opening a bank account is a little more complicated. For non-resident aliens, you do need to go to the U.S. To open a bank account. There used to be ways to open it remotely, but I just don't think any of those ways now are legitimate after some rules changes late last year. So you will need to do that on your trip to see the Grand Canyon. Okay, that's all I got. I'm still connected to the internet.
No, you're still connected. It looks good. So a lot of people ask questions. You said just open it in your respective state if you're a U.S. resident living there. A lot of people have heard, that, oh, you should do it in Wyoming or Delaware, Nevada, or whatever else. Can you speak to what you think real quick about opening it in a different state if you're living in the U.S. as opposed to the one you're living in?
Yeah. So basically, there's no juice to be had by opening it in a different state, and in fact, you'll just cause yourself to do more paperwork. So generally, if you live in Texas and you have a Wyoming LLC, you'll have to get that Wyoming LLC authorized to do business in Texas, and that involves filing paperwork in Texas. Well, if you got to file paperwork in Texas anyway, you might as well file the paperwork to start a Texas LLC. So there's just no, there's no benefit. And then the margin tax is going to apply anyway. Same thing with like a California. If you're in California, then you have to pay an $800 fee for the privilege of using an LLC. Well, you got to pay that fee if it's a California LLC. You also have to pay that fee if it's a Wyoming LLC. So there's really just, all you're doing is creating more paperwork for yourself and not getting any benefit. And then also, you still have to pay state tax. If you're in a state with an income tax, then that income tax applies to you, the human living in that state. And so operating through an out-of-state LLC is not going to get you out of state tax. So yeah, just use an LLC in your state and off you go.
Cool, thanks. And then can you just clarify real quick, there's a lot of confusion between income tax versus sales tax. Maybe can you just discuss that real quick and kind of clarify that we've been talking about it's like income tax?
Yeah, absolutely. Okay, yeah, that's a good point. Thanks for bringing that up. So yeah, we've been talking only about federal income tax and also self-employment tax and employment taxes, but those are still federal taxes on your income. So in the colloquial sense, they're still income taxes. So there's a whole different thing that is sales tax, okay? Now, how sales tax works when you're selling stuff online is, in its nascent stages, okay? You would think that, the internet's been around for a good number of years now. You'd think they're gonna have this thing figured out, but really we don't, And so how sales tax works is very complicated. If you live in the US, well, then you absolutely do need to collect sales tax for the state where you live. Okay, so that one's pretty easy. For people in the other two groups, though, things are a little more complicated. So states are broke, and so they are well, okay, let me start at a different place. Okay, in order for you to be required to collect sales tax from a state, or collect the sales tax of a state, you have to have what's called nexus with that state. And nexus just means a close enough connection to that state to be required to collect the sales tax, imposed by that state. And you live in a state, and you wake up every morning in Texas, and that's where you're operating your Amazon FBA business from. Well, yeah, you got nexus with Texas, so collect their sales tax. But if you're outside the U.S., then it's not clear whether or not you have nexus. Now, states are just absolutely broke, and so they've taken the position that simply having inventory in that state is enough to establish a nexus and therefore require you to collect their sales tax. Now, that is an untested position taken by states. Okay, so eventually someone will spend a whole ton of money to go to the Supreme Court or whatever and fight that. Hopefully it's not one of you guys, but someone's going to do it, and they may win. And so there's kind of basically two different positions you can take. You can kind of kowtow and say, okay, fine, you want me to collect sales tax, I'll do it. And what you're spending is only the administrative cost to collect the sales tax, okay? So for you non-US folks, you're more used to VAT, probably, depending on where you are, obviously. But, like with VAT in the UK, for example, you may sell a product for $100, and then you got to pay VAT, and that VAT comes out of your $100. With sales tax in the US, it works a little differently. If you sell a product for $100, then, and you're collecting sales tax, well, if the sales tax rate is 5%, well, then the buyer is going to give you $105, and then you send that $5 over to the state. So you're not out any money. You're just out, the amount you have to spend to deal with signing up for and collecting sales tax of all those different states. And so this is one of those things where people take different positions. And so normally when people are just starting out and their like gross annual revenue is below, like $5 million, normally they just ignore sales tax. They don't collect it at all. And then between $5 and $15 million is kind of a zone where people agonize, and some collect, some don't. Above $15 million of gross annual revenue, that's kind of where most people kind of say, okay, fine, I'm kind of getting to be a big fish here, and if the state wants to come after me, then I've got something to come after at this point, So maybe I might as well, start collecting sales tax. So that's kind of generally the breakdown of how people who live outside the U.S. Think about it.
Cool. Thank you for that. I know it can be complicated. All right, one last question, then we're going to wrap it up. So I think some of the people listening to this, are entrepreneurs. They're thinking, okay, I'm just going to test out like this Amazon FBA thing. Maybe I'm just going to order like $500 worth of product, throw it up on Amazon, see if it sticks. What are your thoughts about just doing that without setting up an LLC right now? If they're just like testing the waters. And why don't you speak real quick about like what type of risk you're taking if you choose to go that route?
Yeah. if you are in the second or the third group, if you're a U.S. expat or you are a non-resident alien, you're non-American, then there are some complications with setting up these structures, and things get a little bit hairy. And if you really are buying $500 worth of products and throwing it up there, then yeah, I think you could do that without setting up the structure, and I think that's fine. But if you live in the U.S., it's really easy. Like I literally just told you the 3 steps, and that's all you got to do, and you can do it, and it's super easy. And like, it's not like you for like $150, $200 generally, right around there, something like that, you can form an LLC, and it'll be useful for something. I mean, if you don't like doing Amazon stuff, well, maybe down the road you'll do something else, and so your LLC will be there, and you can operate through that. So then, I just think like it's part of being an entrepreneur. Not everything in life is like candy and roses. Like sometimes you got to do the boring stuff. I mean, I just did my own tax return. I wish I didn't have to do that. And I send a whole pile of money to the. Anyway, I won't talk about that. But yeah, I mean, it's not all picking out baby towels with hoods on them. So I mean, sometimes it's not fun. So fire up an LLC and go for it. I think because it's just super cheap insurance, and then you'll just have it and you'll be done. So you may start with $500, but what if you have a home run and you're selling millions of dollars worth of stuff still in your own name? I mean, you feel like a goofball. So
yeah. Okay. Cool. All right. Well, I think that wraps up as far as time for today. Stuart, thank you very much for coming on and presenting that to us. Hopefully that clears up a lot of people's questions there. I know it was a lot of content to cover in an hour, and I asked Stuart to cover, hey, cover it for people who live in the U.S. and don't live in the U.S. and are Americans living outside. So there's a lot to cover. But yeah, I think that was really good, and I really appreciate it, Stuart. So until next time.
Thanks for having me on. I really appreciate it.
Yeah. See ya. Bye.